Before you buy your first investment, you need to understand these first three approaches. Hey everybody, Tim Weigel here, your local real estate agent in the Central Florida area. And today we're going to be talking everything you can imagine about investments. Okay, so welcome for tuning in today. Before we get started, if you find this information useful, please comment, share with your friends, and more importantly, subscribe to my YouTube channel for more information that's going to help you be able to buy and live the American dream in Central Florida. Live where others vacation. So, all right, so investments. I've been doing real estate since 2014. I have dealt with many different types of investments, both helping buyers, helping sellers, locating properties, and trying to really find the right strategy for people. And it is definitely a strategy. So we're going to primarily dig into the three main strategies out there for investments, okay? The first one is buy and hold. This is the one that you typically see. You buy an investment property, you then rent it out to someone. Can be considered what's called passive income. Let's be honest, owning an investment in real estate is anything but passive. There's a lot of work that goes into it. It just, once you get going, it does feel kind of passive. So why do people like it? First off, it's very predictable income. You know, if you get someone in there, they're going to be paying you that rent every single month for the next 12 months, barring nothing personal happens with them to where they do. The good news though, if something does, the house to have a roof over your head is the last thing people stop paying on. So the other side of it is when you have these investments, you always are constantly seeing these real estate homes prices appreciate. So while you're paying it, you're also having appreciated value. So say in 5 years when you sell it, you're going to earn some money, and hopefully that money makes it to where you're making a lot more money off it than just the rent that you used. Everyone thinks with these type of investments, you buy it cash, but there are many investors out there that actually buy it with a mortgage as well. And that's a different strategy that we could talk one-on-one about. But if you buy a home to rent out with an investment like that, you put a hefty down payment on there, and then what happens is your tenant is paying down your mortgage. So you're growing exponentially over the years, which is a good thing for you. And of course, you got the tax advantages. You know, talk to your CPA about it, but there's different tax advantages, and also investing in properties like this really is a good way to hedge against inflation. As we know, inflation's really going on. So when you're buying these homes to invest, there's a lot of different local considerations. And some people, there's so many ways that you can look at it. But school zones, the community you're in, the area of towns, you know, if those areas are hot, you're going to have competition to get into those areas. And with those competition, same thing's going to happen when you decide to sell. The market's going to go up. It's going to be a more desirable market. Also, if you get into a good school zone and someone's renting, they're going to want the good school zone to help them as well, be able to put their kids through. So there's lots of advantages of that. Property taxes is another thing to consider. So know what's going on with property tax. As it's been mentioned many times in the news for the last year, Florida might be getting away with property taxes. We won't know where it's going. But it does look like non-homesteaded, which a rental would be, will still be charged a property tax. And then of course, HOAs. Do you buy into an HOA? Do you not? The HOA could add some extra value or benefit for your tenants to help you rent out the home, which is a good thing. But at the same time, they might have some restrictions that hurt you. And a lot of times, like the HOA I know I live in, if the tenant does something that violates the HOA rules, it falls onto the actual landlord. So it'll fall on you. So got to keep that in mind. Okay. So, but all in all, hold and stash, buy and hold, those are not bad ideas. Now, the type of investor that this is the best for is going to be investors wanting steady income. So if you want steady income that keeps growing over time and you just keep inching away at your future retirement, this is a good one. It's good for long-term wealth builders as well as low risk tolerance. Lots of people might say there's big risk in here. What if something breaks, put on a new roof? But compared to other items that are investment strategies, this is very low risk, and even if you put on a new roof, there could be some tax benefits for your actual taxes. So talk to your CPA. Here's another way to look at it. So let's just say you want to retire at the age of 60. Okay, that's in 15 years, we'll say. What if you were to buy a home every year? Or even every 3 years? We'll call 3 years. So say if you buy a home every 3 years, that means you'll have 5 properties by the time you're 60. Now, if you end up with 5 properties that you are renting out, you could be renting out, let's say, we'll call it $500 a door profit. $500 a door is $6,000 a year. $6,000 a year times 5 is $30,000 of potential income a year, okay? If you look at the average median price in Central Florida, you're talking somewhere between like 40,000-ish. So those 5 homes are almost working for you without doing work for you. Think about it. All right, so strategy number 2. This one is going to be a little more risky, and you got to be very risk tolerant on this one. But it's the fix and flips. This is what you see all the time. You buy a home that needs a lot of work, you fix it up, you get it at the right price, and you sell it, and then hopefully you make a good lump sum payment for it. You have a lot of risks on that because you got to have all the capital to do the repairs. Once you really start doing the repairs, who knows what you're going to encounter? It could be some interesting issues that come up that you've got to address. And then secondly, it's about finding a way to get that sold. And in between that period, you're going to have expenses on that property until it closes. So the real goal here is to, of course, obviously buy below market value, renovate, and then resell for a profit. Sounds simple. So investors like it just because it's a fast capital gains. Like when you get this ironed out like a machine, you buy, renovate, and flip, and in 3 to 4 months, you get a check. And that check could be $50,000, $60,000 per flip. So very high potential for short-term returns. And then of course, it's an active strategy. You gotta be very hands-on. This isn't something that you just buy, flip, and hopefully it shows money. You gotta be working these projects. You gotta be showing up to the property. You gotta stay on top of the workers. Like you're managing a big project, okay? Some of the local considerations, and you might see these in the emails. Have you heard of the term ARV? ARV is after rehab value. So what happens is when you're looking at the property, you got your property here, you want to know what the after rehab value is. So say if you get a property at $300,000 and after rehab value is $350,000, that $50,000 gap isn't that big of a margin. You would need something closer to $450,000, $500,000 to make it worthwhile on there. You also got to know your rehab costs. So there's certain things that has to be done. Roof, AC, plumbing, electrical. These are things you need to know about, okay? And now when you also do it, then you got to look at the cosmetic, paint, flooring, kitchens, bathrooms. All those really, truly do matter for you, okay? And then of course, local buyer demand. If you buy in an area because the deal looks good, but the buyer demand is not in that area, then when you flip it, it's going to sit on the market longer. The longer it sits, the more money it hurts. Okay, and I'm not even talking about the fact that you might have to reduce the price. I'm talking about the fact that you're paying out money for the upkeep of that property until it sells. So the holding costs. You got to know your permit requirements. All things you need to consider whenever you're doing a fix and flip. This one is, of course, really good for someone that wants to be an active investor. You really want to work it. You're not trying to find passive, but you're being active. You got to be comfortable with risks. You could buy a home today, and one of the bigger risks are, what if you buy it, it takes a little bit longer than expected to get the home repaired, and then the market starts shifting. The market starts shifting downwards, you're losing money the longer that you wait. And of course, those who enjoy project management. So if you're a project management type of person, that would be the perfect home for you. Next strategy, the third one that we're going to talk about, Short-term rentals. So this one is got a lot of potential, but you also got to think about it. You're basically buying a business. Okay. So you got to focus on what you're buying, where you're buying, and know what your market's looking like in that area. This isn't one where you buy and hope. You really got to do that research before you buy. And then from doing that, you can determine if it's going to be profitable. If it is profitable, you're going to be sky's the limits. So this is, you're literally, as I put it, you're buying a hotel. Okay. The reason why some investors like it is higher cash flow potential, flexibility of use, and of course tax advantages in some cases. Now, one nice thing about this is, like, say you want to buy a short-term rental. Where do you like to vacation? Gatlinburg? Do you like to go on ski trips? Maybe that's where you buy so that you can take advantage of you going in there. So even if you're not making hand over fist type money from the short-term rental, you get to go enjoy it a little bit too and save some money from when you stay. Some considerations, of course, city regulations. Not all places are zoned for short-term rentals, so you need to know the zoning requirements. Some of them have a waiting list to get the permits. Some of them only allow so many to be rented out or be short-term rentals in the area. So sometimes those regulations might change with the city. So you gotta stay focused to local municipalities. Zoning restrictions, definitely the HOA rules. HOA might tell you, yeah, we're zoned where you can have it over here, but the HOA says no. So the city cannot force an HOA to accept it. Tourism demand and the seasonality. So this one, the income could be very seasonal. You might end up with months of no vacancies and then suddenly go months with vacancy. And that's a big thing to think of. You might get all your money in one lump sum, so you use that to take care of your expenses. This is good for investors comfortable with management, because you really are managing. You're managing the property management company that you might hire. You're managing everything, every aspect of it, and you really need to dive into those numbers. Those nearest attractions or business hubs, you need to know what's going on. Very, very important. This is a high risk, high reward type of game. So those are pretty much the three types of investments out there. You want to build wealth and you want to live the American dream in the vacation destination of the world. These are some ways you can do it for sure. Now, there's a few other ones that we just want to talk about to briefly introduce you. So first off, there's house hacking. What a house hack is. So if you want to get into an investment, and this is really good, especially if you're younger, you don't have a family, buy a duplex. Buy both sides. Live in one, rent out the other. Because you're living in it, you have certain loans that you'll qualify for that a normal investment strategy wouldn't work. So it helps you get into it a lot easier. Then you can rent out the other side. And the whole idea is that hopefully you're renting out the other side, covers your mortgage. Then years down the road, you move out, you get both of the mortgages covered by both doors. It's a win-win. There is the BRRRR method. So this one is, you buy a home, you rehab it, you rent it, you refinance it, and then you repeat. Okay? So if you understand, you buy it, you rehab, kind of like a flip, then you rent it. Now, because you rehabbed it, the whole idea is when you refinance it, you'll be able to take out more cash. For example, maybe you can take out an extra 200K. Take out that 200K, you can then go ahead and do it into the next project. Makes sense. Of course, there's commercial real estate. Nice thing with commercial real estate is you don't have to worry about them renewing your lease, and they're most likely going to pay year in, year out. And then, of course, land investing. We're not building any more land. So if you see a property and you think people are building out to it, hold it and stash. I once had an investor buy a bunch of land out in St. Pete. Nothing serious, very small partials. Talking $5,000 piece of land in cities. and then he ended up selling them for $15,000-$20,000. So think about it, 4 times what his original investment was, only in a couple of years. So I have this little table here that I did some research on just to give you an idea. So the strategy, say buy and hold. Risk level is low to medium. Cash flow is very steady, so it's going to be your most consistent one. Time commitment is also low to medium. And then speed of returns is slow because it's steady and it's kind of like got the tortoise and the hare philosophy. Slow and steady wins the race. That's how buy and hold is. Then there's the flip. Risk level is medium to high. Cash flow, lump sum up front. Time commitment, high. Speed of returns, fast. So it's fast and free. The faster you do it, the more successful you'll be at flipping. And then there's short term. Risk level is medium. So cash flow is high potential. Time commitment, medium to high. And then speed of returns is also medium. So there's a little something for everyone. You really got to decide what your profile is and what your strategy is. If you're good at one thing, you don't need to explore out the other. Slow and steady wins the race. I had an investor that's been doing the rentals for years, and he does very well at it. And he has built up his portfolio of rentals, and he does not try to sell those rentals. But he's very secure financially, and it's all because of doing this time and time and time and time again. Now, I'll be honest, doing that rental strategy, it ain't sexy, but you're not trying to be sexy. You're trying to get the job done, okay? And what that strategy does is it helps build long-term wealth. There's certain things that are more short-term. If you do flips, they're short-term. But you also got to think the ones that are the most lucrative flips, you're going to be fighting a lot of investors trying to get those flips out there. So here's the big question. Hearing all these different styles for strategies, what strategy fits you? Are you leaning more towards flip? Or are you maybe more of a hold and stash or rental type person? Or do you want those vacation rentals so that your family can go enjoy them too? So this is all very good. So again, as mentioned earlier, subscribe to my channel if you haven't. Share this with someone that you need to know. And if you want a private investment strategy session with yours truly, connect with me, reach out. Let's set up a time and talk. I'm always free to discuss that strategy. So happy investing.